Regulation matters most when it shapes decisions. In this section, we turn stablecoin and RWA regulatory comparisons into strategy: where to launch, when to partner, how to expand, and how each choice fits the business model. So far, we've built the foundation: why market structure matters, how US rules are evolving, and how regulation shapes stablecoins, real-world assets, and tokenized products. We also compared global regimes such as MiCA, Singapore, Hong Kong, and the UAE. Now we use that comparison to make better jurisdiction and product decisions. Product strategy starts with one integrated question: where can we operate, how will we participate, and whom are we built to serve? These choices reinforce each other. A jurisdiction that works for institutional custody may be wrong for retail distribution. A partner-led model may reduce licensing burden, but limit control. Building infrastructure may create differentiation, but add operational and regulatory complexity. The goal is not to find the easiest market or the broadest customer base. It is to align regulatory clarity, business model, customer segment, and risk appetite before early decisions become expensive constraints. Choosing a jurisdiction is an executive trade-off, not a search for the most crypto-friendly label. Begin with regulatory clarity. Does the law define the assets, roles, and licenses your model depends on? Then test operational feasibility. Can you actually secure banking, custody, compliance support, auditors, and legal infrastructure? Next, assess market access. A license is less useful if it excludes your target customers or limits distribution. Finally, weigh the risk profile: supervision style, enforcement predictability, tax treatment, and cross-border rules. The best jurisdiction is where strategy, operations, and risk tolerance align. Licensing is the first real go or no-go test. Before launch, the team has to classify the asset, identify the regulated activity, determine the required license, and confirm where distribution is allowed. For stablecoins, that may mean payment, e-money, banking, trust, or dedicated stablecoin permissions. For RWA platforms, it may involve securities, fund management, broker-dealer, exchange, custody, or transfer agent rules. Clear pathways reduce launch risk, but add cost and supervision. Ambiguity can feel flexible early, yet it increases enforcement risk and can make investors hesitate. In mature digital asset markets, regulatory approval is not the finish line. It is the start of a supervisory relationship. Early engagement helps firms clarify expectations before major product, capital, or market commitments are locked in. During authorization, regulators look beyond the application itself to governance, risk controls, reserve transparency, and consumer protection. After launch, the dialogue continues through reporting, reviews, and remediation where needed. The quality of that engagement can affect launch timing, product scope, banking relationships, and investor confidence. Some jurisdictions offer sandboxes or pre-application guidance. Others expect formal submissions. Legal approval is only one part of launching a stablecoin or RWA product. The operating stack also has to work in practice: banking access, reserve management, asset and token custody, trading rails, compliance checks, reporting, and redemption or settlement operations. If any link is weak, the product slows down or becomes risky. That is why jurisdiction analysis cannot stop at the statute. A market may look friendly legally, but if banks will not onboard issuers, or custodians and liquidity providers are thin, speed to market and customer trust suffer. Infrastructure depth often decides viability. Issuing or offering a product in one jurisdiction does not mean everyone can access it. Retail customers usually bring the heaviest obligations: disclosures, suitability checks, redemption rights, complaints handling, and consumer protection. Professional, accredited, or institutional users may allow a faster path, but with a narrower audience. The same logic applies across borders. Marketing, payments, securities rules, and licensing can change country by country, and even channel by channel. Eligibility should be mapped against customer type, location, access channel, and each activity: buying, holding, redeeming, transferring, or earning yield. Jurisdiction choice is not just about getting to market quickly. Tax rules can change the economics of every transaction, from token transfers and redemptions to reserve income, capital gains, withholding, and investor reporting. Enforcement risk is the next layer. If the product looks like securities activity, banking activity, or operates in an unclear legal zone, regulators may challenge it later. Reputation also matters. Banks, institutions, boards, and investors care whether the jurisdiction is credible. A place that feels low friction can still be high risk if it creates tax uncertainty, banking fragility, or limited cross-border trust. Participation does not always mean becoming the issuer. Building gives the most control and margin potential, but it also brings the heaviest licensing, compliance, operations, and balance sheet responsibility. Partnering shifts some of that burden to regulated specialists, such as custodians, broker-dealers, transfer agents, or tokenization platforms. Integrating is lighter. You embed existing stablecoins, wallets, custody, or settlement rails into your product. Distributing is lighter still. You provide customer access to regulated tokenized products without manufacturing the asset. The strategic question is, how much control do you need, and how much responsibility are you prepared to own? Becoming an issuer is the highest control model and the highest obligation model. You are no longer just using infrastructure. You are making promises to holders, investors, regulators, and partners. For a stablecoin, that means reserves, segregation, redemption rights, audits, disclosures, and operational resilience. For an RWA product, it means asset ownership, servicing, transfer limits, investor rights, and securities compliance. The upside can be meaningful: stronger brand, better economics, and more strategic flexibility. But issuance should be core to the business model. If it is only a feature, the complexity usually outweighs the control. Partnering with licensed entities can be the fastest route to market because you use existing regulatory infrastructure instead of building every capability yourself. But the operating model must be explicit. Who holds customer funds? Who issues or redeems tokens? Who controls custody, data, reporting, and support? Contracts need to cover service levels, audits, termination, and what happens when something breaks. Most importantly, outsourcing a regulated function does not automatically outsource accountability. A weak partner can damage customer trust, slow regulator confidence, and constrain your strategy later. Integrating a third-party stablecoin or tokenized product reduces issuance burden, but it does not remove responsibility. You are still accountable for how the asset reaches users. Start by selecting the asset and use case. Then verify the issuer's authorization, reserves, and redemption process. Next, assess custody, sanctions controls, and operational dependencies. Map exactly what rights users receive: redeemability, claims, fees, and limits. Confirm where the product can legally be offered. After launch, monitor issuer changes, geography, marketing, and yield features, because retail access and investment-like returns can raise the risk profile quickly. Before launching a stablecoin or RWA product, force the team to answer 4 decision questions. First, what exactly is the asset? Who is the issuer, and which rules apply? Second, who controls reserves or underlying assets, provides custody, and owes redemption? Third, what licenses are needed, and where can the product be marketed, transferred, or redeemed? Finally, who owns compliance, disclosures, sanction screening, resilience, audits, and incident response? If any answer is unclear, do not go. Rework the model or stop. The main takeaway is simple. Strategy comes before launch. The right jurisdiction affects licensing, banking, custody, tax, enforcement risk, and distribution. The right operating model balances control, speed, compliance burden, and risk appetite. Before moving forward, executives need clear answers on asset classification, issuer duties, reserves, redemption, licenses, and permitted markets. Next, we translate this into CEO-level priorities: